welcome to Relax with Tax. We've been doing this program, as I said, for dozens of years, and it's endlessly fascinating because, as you know, everybody has a relationship with the IRS and with the state government through their taxes. And the funniest story that I remember from my work at California Lawyers for the Arts, a guy called up and said, you know, I think I need to see a lawyer about my taxes. I said, what for? Because we don't usually refer people to lawyers for tax advice unless they have some serious problem. He said, well, I haven't filed for 7, 8 years. I said, wow, what's inspiring you to file now? He said, the IRS just moved into a building across from me.
That's something.
Thank you, Tom, so much for your support through these years. We really appreciate it. And I want to thank Keegan and Jill Royson who put this together, as well as Intersection. Thank you.
Thank you, Alma. And thank you all for coming out tonight on a stormy night. Hopefully I can get you some information that will be useful. What I normally do with this is talk about, well, first of all, I'm going to talk about the new tax law. That'll be first. And then we're going to talk about certain areas that I find are of interest to artists, creative folks. And it also, these areas actually are the ones that seem to be audited by the IRS quite a bit. And those areas are going to be auto expenses, depreciation, travel, meals, office and home. If we have time, I might get into hobby loss also. And there'll be other expenses we'll talk about as the evening progresses. Those types of expenses, as I said, do get audited when your return gets pulled for audit. Nationally, about 1% of all returns are audited. However, if you have a loss on your tax return, on your what's called Schedule C, which is your profit and loss from your business, I have the forms in here and we'll show you that in a minute. I find that if your loss is $5,000 or more, that there's about a 1 in 4 chance of being audited. So that's high. So that's just something to be aware of. By the way, being audited is not a death sentence. Every one of my clients has survived, has been audited. But it's a pain in the neck. And, you know, the best case usually is that there's no change. As we're progressing through the talk tonight, I will also talk about documentation. The more documentation you have, the better. You always want to have receipts for expenses. If you travel, you're going to want, then I'll get into the documentation you want to have there. But the more documentation you have, the better off you're going to be. You'll feel a lot more comfortable if the IRS comes calling. Again, it doesn't happen all the time. As I say, nationally 1%, so don't freak out about it. But it's just be aware of it. And it also gives you some good practices, too, as far as running your business. One thing you'll notice about this taxes this year is that these forms are different than the returns we've used in the past. The Form 1040, which is number 1 on your sheet there, used to be 2 pages. Now it's 1. This was done by Paul Ryan, who showed us that he wanted to get us all in a postcard. And so they're cramming all of this onto one sheet. However, funny enough, by cramming all this in one sheet, they've created 5 new schedules. So, you know, it's typical. I won't get into politics, but it does seem typical, shall we say. So, in addition to this one page 1040, then right behind it are 3 schedules that are, again, very common. And all 3 of these schedules used to be on the 2-page 1040. So, less or more is less or something. I don't know. So anyway, we'll get into that. But it is different, and that's obviously the most you'll see that change. Everybody will see it. The new tax law, and when I say new, it actually was passed at the end of 2017. 2018 is the first year that has affected us. It made a lot of changes, and we're certainly not going to get into all of those. A lot of them were business related, and we're talking big businesses, corporations and such. But there are several changes that I do want to point out to you. Basically, probably most of you have not filed yet. One problem is going to be withholding on your taxes. They did change the tax rate withholding schedules in February of this year because they wanted to get money into everybody's hands as soon as possible is to build up support and show us what a great thing it is. So what's happened, unfortunately, is that the tables are built on as if your old withholding exemptions, a lot of you will claim single and 1 or 2, 3, 4, or 5 or whatever, and those exemptions were calculated under old rules. And now, if you have to claim 5 exemptions, that's a lot of exemptions, especially if you don't itemize your deductions, and we'll get into what itemizing deductions are. So anyway, we're finding that people tend to be underwithheld, and you've seen it in the papers. I think it's I saw one stat. I think it's refunds are down 17% and blah blah blah. One thing is, it's true that you actually did get that money earlier in the year, and of course, if you're a normal person, it's gone somewhere. It's been spent or enjoyed or whatever, paying bills. So that it's unfortunate. But anyway, so be aware of that. You probably want to get your return done as soon as possible to give yourself enough warning, that you may owe taxes, because it could very well happen. Right? That's not to say that it won't. I will say, if you claim only 1 exemption, and you really don't have a lot of income other than a W-2, then you're probably going to be okay, and there's not a lot to get too excited about. But if you claim more than 1 exemption, or if you're married, then it could change your taxes from what you're used to in the past. So again, I think getting ready to get the return filed early is a good idea. You don't have to file it, but at least prepare it and get it ready to go. All right, some changes that we want to point out to you. Standard deductions. In past years, if you were single, I believe the standard deduction was $6,700. This year, it's $12,000, so that's a plus. Unfortunately, they've taken away personal exemptions. And those were, if you're single, you had 1, and that was worth about $4,000 last year. So in 2018, that's gone. So in effect, they've raised the standard deduction by about $5,000, but they've knocked out exemptions. And if you're 1, then you really have maybe just a little bit more negative. You reduce your income a little bit, but it's pretty much the same. If you have children, then in the past you've been used to getting what's called an exemption for them. Those are no longer around. They have been replaced, depending on your income level and how old your kids are, by credits. And credits are good. I mean, these actually, if you have kids, this is a good provision. Children that are under 17 at the end of 2018, you will give you a $2,000 credit per child, unless your income is very high. So that's good, but no exemptions. And so if you have college-age kids, you would have had exemptions for them in the past. Now you get a $500 credit rather than the full exemption. That's one main difference. I don't know if most of you know what itemized deductions are. Those are personal deductions that are claimed on Schedule A. These are basically medical expenses, property taxes, state income tax, home mortgage interest, contributions. In the old days, you could get miscellaneous itemized, miscellaneous itemized deductions, which employee business expenses were miscellaneous itemized deductions, and they were deductible to the extent they exceeded 2% of your income. So you lost some of them, but not all of them. So in 2018 and beyond, those are eliminated. So no more miscellaneous exemptions, and so no business expenses. Again, you can take business expenses if you have a business that you file on Schedule C, but for employee expenses that are unreimbursed by your employer, unfortunately, there's no benefit for that. One other thing that I want to point out is that these changes I'm talking about here that were made in 2018 do not affect California. California is under the old tax law. So those rules are still the same, and so you could have employee business expenses this year for California purposes. So it's made it just a little bit more complicated, of course, but don't forget that. Another major difference this year, and again, if you don't itemize your deductions, if you're a renter and you don't know what a Schedule A is, then you really don't have to worry about this, but I'm sure some people are homeowners out there. And you may have heard of this, but in the past years, you could deduct all of the property taxes on your house, plus all the state income taxes that were withheld from your check or you paid in through estimated taxes, plus there is a personal property tax on your car that you could take as a deduction. That has been changed so that in 2018 and beyond, the most of those deductions that you could claim is limited to $10,000. So that can be a major change for certain people. And there's nothing you can do about it. That's just the rules. So basically, these changes in the itemized deductions are going to affect taxpayers, and a lot fewer people will itemize than have in the past. In past years, about 70% of people did not itemize and just filed a standard form without the itemized deductions. This year, the IRS estimates it's going to be 87%. So it's more than cut in half the people that will itemize their deductions. So that's tax simplification, I guess, and it does, but it makes it where there's just as less things that you can deduct. Those are major deductions on your Schedule A form. Another big deduction that they put in that actually will be a benefit to anybody that makes money from their business is there's a new provision that gives a 20% deduction for your income from a trade or business. So it's pretty good. So basically, you have a Schedule C, which again is when you are in business for yourself, or you get a 1099 from people. Your net income from that, we're going to be able to take a 20% deduction from your taxable income. It's not a credit, it just reduces your taxable income by 20%. But it doesn't matter whether you itemize your deductions or not. So this is an addition to your standard deduction. The way to compute that is you take line 31 here, which in this case is $19,620. So that's your profit from your business. But you do have to subtract a few things before we get to figure out what the 20% deduction is. So from that figure, we're going to deduct half of the self-employment tax that you wind up paying. And again, we'll talk about self-employment tax later, but just briefly. And that is going to be on page 2 on one of our new schedules. That's on line 27, where it says the deductible portion of self-employment tax, which is basically half of whatever you pay in self-employment tax you get to deduct. Well, that you have to reduce your net income from your business by that amount. In addition, you have to reduce it by any self-employed health insurance deduction that you take. You're entitled to take, if you pay for your own health insurance and you're self-employed, you do get a deduction for that health insurance. And it's not an itemized deduction. You get to take it whether you itemize or not. It is limited to up to your net profit from your business. So if you make $5,000 and you have $10,000 of insurance, you can only deduct $5,000. But still a good deal. It will be on line 29, that deduction for self-employed health insurance. And basically, if you have your own health insurance and you're self-employed, you can take deduction on line 29 here of whatever amount you wind up paying. Now, this will be net of any, if you have Obamacare credits, covered California here in California, you would reduce whatever you wind up paying by that amount. And then the final thing you have to deduct from your business income is if you make any SEP contributions. SEP contributions are like IRA contributions, but you can make them if you're self-employed. And you can contribute up to 20% of your net income for retirement purposes. So that's the 3 deductions that we're going to that you have to take from your business income. But whatever's left, you get an income tax deduction of 20% of that amount. Now that deduction is going to show up on line 9, which is the qualified business income deduction. And again, you get that deduction whether you itemize any of your personal exemptions or personal expenses or not. So it's a good thing. All right, so that's the main changes. Maybe real quick, does anybody have any questions on changes that they are confused about? Or yes? the question is about whether Social Security is subject to self-employment tax, and it's not. Self-employment tax is only on net profit from your business activities. So any wages, interest income, dividends, Social Security, pensions, you don't pay the self-employment tax on that. It's simply on profit from your business. Let's go on here then and talk about some of the deductions. And I want to go over the forms a little bit before we even get into that. So let's turn again to Schedule C. If you have income that is not wages and it's from a business activity, it would be reported on Schedule C. And this Schedule C, as it says, is a profit and loss from your business. So a couple things I want to point out, just sort of the mechanics of filling out the form. If we look right near the top in the upper right-hand corner, Part B, where it says enter the code. For artists, that's the number. These codes are in the instruction booklet, but I'll give you that number. For musicians, anybody, any creative artist, that's the number. Filmmakers will have a different number. 2, and this is a counting method on line F. So there's basically 2 methods of accounting. One is called the cash method, and one is called the accrual method. I have never, I'm trying to think, I don't think I've ever seen an artist that's been on the accrual method, so I'm not going to really talk about that. The cash basis says is that basically you pay tax on income when you receive the income. So it's not when you deliver the painting or the work that you do or perform the services, but when you get paid for it. And conversely, you don't get a deduction until you actually make the payment. So if somebody's done work for you in the current year, but you pay them in 2019, you get the deduction in 2019 rather than this year. Generally speaking, it's a good deal for artists and for everybody, because most of the time people owe you more money than you owe them. And so it works out well in that regard. One exception to this rule is that if you charge an expense on a credit card, those are allowed to be deducted in the year you make the charge rather than in the year that you pay the bill. So if you charge something by December 31st of 2018, you get that deduction in 2018, even though you pay the bill in 2019 or even later, for that matter, even if you carry it and don't pay it all off in time. So that's somewhat of a taxpayer-friendly provision. A couple of questions that come up in cash basis, and we all have them if you've been in business long enough. Bad debts. Somebody owes you money and you don't get paid. And the question is, can you take that as a deduction? And the answer is no for cash basis taxpayers. The reason is that you never took in that money as income, and therefore if they gave you a deduction for it, it'd be like a double dip. So no deduction if somebody hasn't paid you. You would be able to deduct whatever it costs you to do that work or do that painting or whatever, but that's about it. So it's, yes. The question is, if you're a painter and you've given this person a painting and he said, I'll pay in 2 weeks when I get my money or whatever, and they never pay you, there's no deduction for that if they don't pay you, unfortunately. You have not paid any tax on that income because under the cash basis method, you don't pay tax on something until you receive it. Since you never received it, but you don't get a deduction for it either. It's just a wash. Yes. This is if you've loaned them money. You can certainly take a deduction for that. If they gave you a note for your services, it's actually kind of a bad deal, because if they do give you a note for your services, that actually is income for you then. And if you don't get paid, then you could take a bad debt deduction for that. But that doesn't happen too much. It's usually when you loan a friend money or somebody you know or whatever. And then you can take a deduction, but it's a little more complicated. Kind of in the same vein here on these types of income things, people want to know, can I take a charitable deduction for performing services for a charity, like California Lawyers for the Arts, like tonight for me, this is a charity. Or I give, a lot of times people will give, very generously will give paintings to an art auction or something like that. And unfortunately, it's sort of the same theory there. No deduction for it, because you never had income from that piece. You can deduct the cost of the of doing the painting, the paint and the canvas and all that kind of stuff. And tonight I have a bridge toll and coming over here and some of that stuff, so I could deduct that, but no deduction for your time. So those are some of the issues about cash basis accounting that I always come up and I wanted to point out to you. Now let's go down the form, income, which is line 1, gross income. So basically, of course, we always pay tax on everything that we earn, that we get paid for. You have to pay tax on something even though they pay you cash, even though you don't get a 1099 for it, and blah, blah, blah. So I'll leave it to your own consciences on what to do, but that's what you're supposed to do, and most people do. I think we have a pretty high rate of compliance in the United States. It's not 100% by any means, but it's pretty good compared to other countries. You need to report all income. And again, this is for services or goods that you've sold. You know, somebody gives you money, you know, your mother gives you some money, that's not income, you don't have to pay tax on that. Or you get a loan, that's not income, you don't have to pay tax on that. It's funds that you have earned, either through your services or for something that you have sold that is business related. So basically, the IRS always wants line 1 to be equal to or greater than the total of all the 1099s that you receive. And I presume everybody knows what a 1099 is, and if you don't, here's what it is. It's basically somebody has paid you for services $600 or more and is required by the IRS to tell them that they paid you. And that goes to the IRS, and the purpose of it is so to track, to make sure that everybody reports everything that they have earned. If you don't, if this line 1 is less than the total of all your 1099s, the IRS is going to send you, either they'll come knocking, or more than likely they'll just send you a notice to say, hey, what you owe us tax, why is there a difference? Now, sometimes there are legitimate reasons why that will be less, and that comes kind of as a following through on the cash basis. A lot of people will pay expenses on December 31st, knowing, you know, this is the last day of the year that I can get an expense for 2018, and so they dropped their check in the mail on December 31st, and legitimately, they can take a deduction in 2018 for that amount. And they are required, if they pay $600 or more, to report that in a 1099 to you for this year, for 2018. You're on the cash basis also, and don't have to report income until 2019 on that. So the problem arises when you get a big check on January 1st, or well, it'll be January 2nd, because the post office is closed, or whenever that comes in, and it's included on your 2018 1099. So it's a problem. The way to there are a couple ways to approach this. One, if you're even taking that into account, if your 1099s are still less than the items that you're reporting on, or the income you're reporting on line 1, then you don't have to worry about it. There's not going to be a problem. The IRS won't address it with you. But if it is a problem, then what I normally do is have you attach a statement to your return to say, hey, I got a 1099 in 2018 for $10,000. I received it on January 2nd. Here's a copy of your bank statement showing, you know, that that's when it came in. I will report it on my 2019 return, and therefore I'm not reporting it in 2018. That works. I have had it where people have done that, and they still get a notice, and then you just have to sort of repeat it to the IRS when the computer generates a notice. But that's the best way to handle it. Yes, sir. So the question is, income on a 1099 does go on line 1. Also, though, like if somebody buys one of your painting or whatever from you, that would also go on line 1. And generally speaking, you don't get a 1099 for goods that you sell. Okay, so that's kind of it on, one other thing. One other thing with artists, painters, filmmakers, some of your income you might get on your 1099 might say, instead of non-employee compensation, which is the typical way it comes in, sometimes it'll show up as a royalty. Non-employee compensation on 1099 is on box 7, royalties are on box 2. So they're both income to you, and they do go on Schedule C. However, if you do have a royalty, and the IRS sees this on the 1099, they think of it as a royalty, and they want to see it on a different schedule. And so I've included that schedule in here. It's Schedule E, which is page 7, and this is for basically Part 1 is for income from rental, real estate, and royalties. So let's say you get a royalty for $1,000 on your 1099. I report that in full on line 4 here. Or actually, in this case, we're using $1,500. But it really is income from my business. So to make sure that the IRS knows that I do know that I got that money, I put it in gross here. But then down below on line 19, I put in a little statement to the effect, royalties reported on Schedule C and $1,500. So it shows up as an expense. So the whole thing nets out to 0 on the Schedule C, or Schedule E. Line 21, which is the net income, is 0. In addition, back to Schedule C, on line 6 of Schedule C, I also report that as that income that was not reported in Schedule E. I put it on line 6 there as other income. In effect, by showing it both as income and then as an expense, I am moving it out of Schedule E and onto Schedule C. Now, again, some people do get royalties. Like I have a client who gets royalties for his father's work. And so that's not his earned income. And so that would show up on that Schedule E and leave it there. But again, if you are the creator of the income, then show it ultimately winding up on Schedule C. I would put royalties actually on line 6. That's where that $1,500 is showing up there. But all the other income would go on line 1. We're going to shift to expenses. However, while we're on the subject of 1099s, there is a question that you are asked here about whether you did file Form 1099, which is line J of Schedule C. So, again, the rules on this are if you pay someone for services in the calendar year, $600 or more, you're supposed to send them a 1099. Now, those are actually supposed to be out by January 31st, so you're late. And if you send them in now, you will get a penalty for them. So, you just have to sort of make your own choice if you haven't done them. I would certainly in the future send those out, and you're supposed to do it now. The penalty, I can't remember, I think it's like $100. It's $100 per 1099, so it's fairly steep. So I leave it up to you whether you want to fix it, but you should. Let's talk about expenses. First expense I want to talk about is auto expense. There is a schedule here that I've used to show how this is determined, the vehicle expenses, and that is page 13 here of your material, vehicle unreimbursed expenses. So there basically are two different ways to compute the amount of your auto expense. Both of them require that you know both your total business miles that you drove during the year and the total miles that you drove your car. So you need to know both. So the question arises, how in the heck do I track, how do I know how many miles I drove? And I was talking to a client just today about this, and I do, I'm an accountant, so I actually do have a little spreadsheet that I keep track of my mileage on. So that certainly is the best, is to show, on this date I went here and this is what I spent. It's a little hard to do now if you didn't do this during the year. A second way to do it is to recreate it from your calendar, which is a pretty good way to do it. So that's pretty easy. The only problem is you have to do all this work now, for one thing. And then secondly, I'm sure there are things that you use your car for business that you forgot about and are not on your calendar, so you will actually under-report probably the mileage that you drove. But that certainly is a good fallback position. Finally, you can just sort of give it the old guess. I know I drove down to LA 3 times during the year, and if you can kind of show that you did, you have receipts down there or something, and if it's for business, then, it's what, 400 miles, or do MapQuest and figure out how far it is and take it that way. So you want to determine, your business use. And business mileage is things, coming here tonight, if you're in business, would be business miles. Certainly going to a photo shoot, going to a gig, going to visit galleries to promote your work, going to deliver your work. Those are all business miles. So anyway, it's a little bit of work, but you know, there also are apps that keep track of this for you. So you can do that. But one way or another, you got to somehow figure out how many business miles you drove during the year. So, all right, so basically we've determined how many miles we drove total for the year and how many miles we drove for business. So with that number, and that basically on this form is, we've just completed lines 2 and 3. So then there's two methods, as I said. One is pretty quick and dirty and easy, and that is what's called the standard mileage rate. And so in this case, he drove 5,500 miles for work during the year. Then you multiply that by the current mileage rate, which in 2018 is 54.5 cents a mile. It's printed on here on the form for you. So you just multiply your total business miles by that number, and then boom, that's your deduction. So that's pretty darn easy. By the way, in addition to just the mileage there, you can add a couple of things more into your deduction, even though you use just a standard mileage rate. And that is, of course, parking. You can always take that in tolls. Also, a portion of your license you can take, as well as a portion of an interest on your car. This is not for getting your license to drive, but this is the annual registration for your car. You can take a portion of that. So you get that as a deduction. How to do the next method, which is called the actual expenses. And that, then you do add all the operating costs of the vehicle. And that's going to be gas and oil and repairs, tires, insurance. These are all on line 6 through 11. So you get to add those in, and then you multiply those by your business use percentage. And then you can take the higher of the two. However, once you use a method for a car, then you need to use that same method every year for that car. So if the first year you decide it's standard mileage is better for you, then you need to use that rate for as long as you use the car, and vice versa. Now, let me give you just sort of some quick and dirties on when one method might be higher than the other. Basically, if you don't drive a car very much, but you have a relatively high business use percentage, you know, maybe you only drive 3,000 miles a year, but it's an expensive car and it has a lot of repairs or something like that, and you use it a lot for business, say over 50%, then probably the actual expenses are going to be better. Conversely, if you have a car that doesn't have a lot of expenses, but you drive it a lot for business, you know, some people traveling, salespeople, real estate agents, they can drive 20,000 miles. Musicians, maybe on the road. So in that case, the standard mileage rate usually comes in a lot higher. So those are sort of some rules of thumb. But it's going to mileage will vary, as they say when you're buying a car, and you know, just figure it out either way for yourselves. So commuting expenses are not deductible. So it depends on where your place of business is. If, let's say, you are, again, this is not for waged jobs. This is for your self-employment income. So if you're going out to client sites, then your travel to the client sites or customers or whatever is deductible. We're going to get into office and home deduction a little bit later. And it depends on where your office is. You can travel away from your office, but you can't deduct for traveling to your office. So we're going to find in just a little while that if you work out of your home and your office is in home, then every travel that's for business is going to be business expenses. But if you do have an office, you know, downtown or wherever, and you go into that to work, then that expense is not deductible. I mean, again, if you're an actor, that assuming you're not getting wages for that, sometimes you get paid as an employee for that. But if it's a 1099 gig, then yes, you can take that as rehearsal. Or musicians, but going to rehearsals certainly is a deduction, business expense. Okay, there's one more expense in this actual expenses that I'm going to get to a little bit later on, and that's called depreciation. So I'm just going to leave that there is a line item, you'll see here, line 16, and I'm going to tell you how to compute that a little bit later. kind of not a related expense, but a related calculation is and we just talked about office and home deduction. And the official title of that is business use of home. So let's look at that, how we compute that deduction. And that is reported on Form 8829, which is sheet 11 here in your material. Basically, a couple of definitions or rules that I want to point out to you. You are entitled to the business use of a home if you use a spot in your home exclusively and regularly as your principal place of business. Okay? So what that means is, and they really kind of envision it's like a spare bedroom, you know, that you have, that you work out of. And that works a lot for a lot of people. There are other ways you can use more of your home too for that if you are an artist, because I've had clients that live in a live-work space and they can use 3/4 of their space for work, you know, if that's like studios. Basically, again, it's exclusively. So that means you can't really use the kitchen table unless you never, you know, eat on that thing, or a dining room table. Even though that might be, you work on that a lot. But if you use it you know, Thanksgiving and whatever, then theoretically you can't take that as a deduction. Bedrooms, you know, a lot of times, you know, it's a bedroom and then three weekends a year somebody sleeps in the spare bed that's in there or something like that. So that will not disqualify the entire room. You can use a portion of a room as a deduction. So, you know, you take, it's in the corner, you got your desk and all that here, and maybe it's half of the room or a third of the room or whatever. So you can at least take that part of your house as a deduction. But what you can't do is, again, if it's used for other purposes. The way the deduction is computed is first you figure out what the square footage is that you are using for business. And so again, you know, a typical bedroom is going to be somewhere around 125 square feet, 10 by 12 or something like that. And if it's all used for business, you can take 120 square feet. If half of it's for business, you take 60 as your square footage total. So that part is reported on line 1. We're basically coming up to a business use percentage, just like we did for cars. So you then compute whatever the size of your house is or your apartment, and then divide the business use percentage by the total square footage, and then that's the percentage that you can use of your various expenses. The various expenses are listed basically on lines 9 through 22. And those are going to be typically rent, utilities, insurance, maybe you have renter's insurance, cleaning. If somebody comes in and cleans the place, you can take a percentage of that. That's about it. If you don't own your own home, that's pretty much it. If you do own your own home, you won't have rent, but then you're going to have home mortgage interest, and you're going to have property taxes. You're going to have insurance and repairs, as well as cleaning and such. Yes? That's a good question, and I don't know for a fact. You know, basically, every return is given what's called a DIF score, DIF, which is a determinant index factor, which really doesn't tell you very much. So basically, as it's deviations from the norm. So the higher the higher your travel expenses are, that gives you a certain amount of points, and for all the various expenses. And so, generally speaking, you know, the more travel expenses you have, the more meals and all that kind of stuff, that's going to give you a higher score. And then the IRS basically will turn around and just audit the highest scores. So I can't give you, you know, numbers, but that's the way it's calculated. Good question while we're on office and home is, I'm sure a lot of people have heard the office and home deduction is a trigger for an audit. And that used to be the case years ago. Now it really isn't. I think they've come to realize a lot of us working on it. And so I would not be concerned about that. And just because you use your house for business, go ahead and take that deduction. So again, remember too, the IRS doesn't understand artists. And so they're thinking of the spare bedroom. But you might be using your garage as your studio, or you're going to, you know, or like I say, some of the live works are 75% for business. So, you know, and you can have two bedrooms if that's what you use. So, you know, just don't cheat yourself just because you're afraid you're not going to be, you might be audited by the IRS. Then what we do, we calculate, we basically have added up all of our expenses, and then we just multiply them by our business use percentage, just like the car expense, and that will give you your office and home deduction. Now, there are limitations to this. With autos, you can take it, you know, there are no limitations, assuming you're doing it correctly. With a business use of home, you can't create a loss with this deduction. You can't create a loss with this deduction. So for example, if your Schedule C shows a loss before we even have this deduction, then you can't take a deduction for this deduction currently in this year. It does carry forward so that you can use it against future income, but in this year you can't take that deduction. Or you can use the deduction to bring your net income down to zero, but that's as far as you can go. You can't go below zero with it. But again, you do get to carry it forward. So there's a calculation about, you know, you can sort of follow it through on the form, but basically down in Part 4, it's talking about the carryover of unallowed expenses to 2019. In this instance, there isn't any, but that's where that would go if you have a loss this year. And unfortunately, artists have losses sometimes. So, in addition, we talked about rent as a deduction, and if you're a homeowner, you get to deduct interest, property taxes, and such. In addition, you can also take a part of your what's called depreciation on your residence. So we're about ready to get to depreciation, and I'll tell you how to compute that. But you can take a portion of your house also. By the way, too, getting back to the employee business expenses, it used to be if your employer mandated you work at home, or for the convenience of your employer, you worked at home, you could take a part of your expenses against that as employee business expenses, but now you can't. For your home office, if you have a loss in the current year without taking this deduction into account, then you can't take this deduction in the current year, but you can carry it forward. There's kind of three different parts of depreciation I want to talk to you about. By the way, this is good. We're going to be talking about Form 4562, which is in here on page 9 and 10. And then there's actually a schedule a little further in the back on 14 that also kind of gets a little more detail on that. Three different areas of depreciation I want to talk about. The first one is kind of easy, and that's equipment. And that can be computers, that can be cameras, video equipment, musical instruments, you know, anything other than a car and your house, which we're going to talk about later. So those expenses can be, the new tax law was very good for businesses and allows you to take 100% of the deduction of any equipment that you buy during the current year in this year. So that's a good thing. You know, you buy a laptop, you can deduct the whole cost of it this year. You don't have to, but you can do that. And most of the time, if you have income, you want to take the deduction now because you reduce the taxes you pay now. So that's a provision that you want to take advantage of. Yes. First of all, the easiest answer is just to write it all off of the year that you buy it. But you don't have to do that. And the way you determine how long to write it off is that the IRS tells you how long you can write it off. Cool. And so for electronic equipment and equipment that is of a technical nature, you can write that off over 5 years. For all other equipment, musical instruments are one, frames or storage, I'm losing the term, but whatever, racks, storage racks, or whatever, no, whatever. Everything other than like electronic equipment would be 7 years. Basically, the first year, you can write off 20% of the cost of a 5-year piece of equipment, and in a 7-year equipment is 14% approximately. But there are tables. basically, most of us, if you're making money, normally you want to write it off all now so you get a deduction for it. But there are reasons why you might not want to do that. Where you might want to take depreciation. Couple of reasons would be maybe this is a really low income year for you. You're first starting out and you didn't make a lot of money, you made some but not a ton. Next year you're going to be in a higher tax bracket. So then the deduction for that equipment will be more beneficial later in taking in future years. Software is something separately that's written off over 3 years. Now, it depends on the software. I mean, if you're buying, Office or something like that, I usually just write it off all in one. But if you're buying a major couple $1,000 program or something like that, that would be over 3 years. Unfortunately, no. So you have to sort of follow. And that's a good question. You have to follow that along, and so you will continue to write it off over 5 years. So once you do it this year, you have to write it off for the several years. So basically, again, one reason you might not want to write it all off this year is that your income is going to be low. Another thing is sometimes maybe it is a big income year for you, but on your Schedule C, you don't have a lot of income, but you're going to make more money in future years. On Schedule C, and we're going to talk about this later, but there's something called self-employment tax in addition to your income tax. And self-employment tax is basically Social Security that is normally taken from your paycheck. So sometimes this year you might not have self-employment income, and if you take this deduction, it's not going to ever reduce self-employment income if you take it all this year. Whereas if you depreciate it and take it over several years, then you'll be able to reduce your self-employment tax in future years by that amount. Most, I'd say with my clients, 93% take it all in one year. So when in doubt, take it all. And it's a lot easier to compute and such. So that might be your answer right there. So that's on equipment, everything but cars and houses. We'll do houses next, which it's easy. Houses are written off over for business use 39 years. So you paid $390,000 for your house. You write it off over 39 years. You would get a depreciation of $10,000. That's if you use your house 100% for business. So you still have to take the business use percentage times that depreciation figure. So, normally you're going to take maybe 10% of your house for business, so you would only be able to deduct 10% of that figure I just told you about. So that's housing. Real estate you have to depreciate. However, if you're making improvements to a commercial property, then you might be able to take 100% of some of those costs. And this is usually in, you have an office building or something like that. But right now you can't actually, because there was a law that was supposed to be passed and it hasn't been passed yet. So we're still waiting to see if that's been passed. But, all right, finally on cars. Cars, again, we're getting back to how depreciation expense for that. You can write off cars. There's tables for that. Again, in the instructions to Form 4562, basically, cars used to be very limited in the amount that you could take for depreciation on them. And that's changed somewhat, quite a bit actually, in 2018 and beyond. Used to be you could only depreciate the cost of a car up to about $16,000. And now it is roughly about $50,000 that you can take a depreciation on. And in the first year, if you buy an expensive car, you can actually write off $18,000 of the cost of the car, if it's an expensive car. So a little bit beyond the scope of things, but basically cars are written off over 5 years also, and there are tables, again, for cars that are in the 4562 instructions. Next, travel, meals, and entertainment. Let's talk about entertainment first. You may have heard, and it's true, that you can't take a deduction for entertainment anymore. So entertainment would be, I take a client out to a baseball game or a movie or you know, the opera or wherever. You can't take a deduction for that. However, for you guys, not for us regular folks, but for you guys, a lot of times what most people would call entertainment is really kind of research for you. You know, you're going to a concert, you know, you're a filmmaker, you're going to movies, or you're watching Netflix or something like that. Those are actually not considered to be entertainment expenses, which means that they still are deductible. And in the old days, meaning before this year, you could only take 50% of entertainment expenses. But again, since these are not entertainment expenses, you actually can take 100% of it. If you're a visual artist, you know, you can certainly go to museums and stuff like that. Music, not so much probably, at least going to concerts. But a lot of creative people get input from all media. And so, you know, that there can be the case made for that you can take pretty much everything that is media related. Again, it has to be in your field, it has to be necessary and for your business. But if you can justify it, then you should be able to, you can deduct. Let's talk about documentation. I think this is a good time to do that. You know, documentation is going to be an invoice and then sort of the method of payment. So a lot of times, you know, you're going to charge it by credit card. So you really should get your charge slip. You should have the receipt, the cash register receipt, and then you show your credit card statement to show that you've paid it. So you sort of show it three ways there. The cash register receipt, the charge slip, and this is if you charge it. Obviously, if you don't charge it, you pay by check, and you have your check. If you have by cash, you don't have that, but you know you can still pay by cash. And what you do with cash payments then is you should have a contemporaneous notation of what you did. So either in your calendar, or your logbook, or something to show what you paid. The best thing is to pay as little as possible by cash, obviously. But those are the documentation. Entertainment, meaning again, when I go to the ball game or something, that's out. That's not a deduction. But for you guys, a lot of what other people would call entertainment is not entertainment. Next, we have meals. So there's a couple different types of meal. I mean, a couple categories. All meals, by the way, are only 50% deductible. So that's the rule first off the top. And then they are deductible. For the documentation, meals especially have a higher level of documentation that's required. So what you need to do on meals is that you need to say, well, you need to know the amount and where you were, and then you have to have the business purpose of the expense, and then the relationship to the person you're taking out that you're paying for. So the in-town things have to be with someone else, and even like you know, you go to a conference, but if it's the same day conference and you have lunch, and a lot of times you're probably going to be talking to people at the conference that share similar. You know, you're talking about business anyway, so you could probably take a deduction there. But if you're just sitting by yourself because you're tired or whatever, you know, then you don't get a deduction for it that way. To qualify, again, for the entertainment, or not the entertainment, for the business meals, you have to have a substantial business conversation before, during, or after the meal. So what I do, I try to charge everything on that. On the back of the credit card, they write down, you know, who I was with and what we're talking about, which is always taxes, which we do. Well, I mean, I don't take every meal, yeah, you know, but for the ones that I do deduct. So that's the in-town meals, okay? Then, if you travel away from home overnight for business, then you can, whether you talk to anybody or not, if you're by yourself, then you can take the meals that you spend for business. Or, I'm sorry, you can take the meals that you paid for as a business deduction. Okay, so I tell you about you certainly can deduct the actual cost of your meals. But you want the good documentation, the receipts and such. There's a fallback position, and that is, rather than having the actual expenses, if you can substantiate that you were out of town for business, legitimately, Then there's what's called a per diem rate, and that varies by city, and it's generally somewhere between $50 and $75 a night, depending on the size of the city. New York City is high, Missoula, Montana is low. So on that website, which is easy to find, it's got several columns, and what you want to use is what's called the M-I plus E, or and E it actually is, and that stands for meals, incidentals, and it's meals plus incidental expenses. It's M plus I. And so that, in the column, there's going to be several columns that are going to show for lodging. And then it's on the far right, as meals and incidental expenses come up. That's the one you want to use. As a self-employed person, you can't take, we're going to talk about this in just a second, but you can't take lodging expenses based on this per diem. It's only for meals. For lodging, you're going to have to use the actual expenses. We'll chat about this more later. But even with that table, you still only can deduct half of that amount. So it'll say $74, but your ultimate deduction is only going to be half of that. We got about 5 minutes. There's a couple other areas I wanted to hit on that are important. One was that self-employment tax that I talked about. So when you're an employee, you get a paycheck, you'll have two things of payroll taxes taken out. One is Social Security, one is Medicare. They total up to 7.65% of your salary. A lot of people don't realize that the employer also has to pay in the same amount of money. They match that to the IRS. And the total is 15.3%. Well, when you're self-employed, because nobody's paying any taxes for it, you have to pay that, both halves of that, as what's called self-employment tax. It is basically for Social Security and Medicare, but you do have to pay that on your net earnings on Schedule C. That form is Schedule SE, self-employment, and you follow the form, you pay your tax. As I said earlier, a lot of times, especially if you're making a modest amount of money, the self-employment tax may be more than your income tax. So it's something that you definitely want to consider, especially if you're just starting out and you've never been paid with it before. You are going to pay it. So beware. Final thing I wanted to talk about was estimated taxes. So again, when you're on W-2, you have your income tax withheld from your paycheck, so you don't have to worry about estimated taxes. But if you have earnings that don't have taxes withheld from them, then you have to pay estimated taxes. Those taxes are due quarterly. They're due April 15th, June 15th, September 15th, and January 15th for the subsequent. They're paid on Form 1040-ES. I have a sample of that. It's like a little voucher card, basically. And that is, I think, page 12. Page 12. So basically, pay those quarterly. It's especially, again, when you first start out and you're not aware of this, it can be a real problem because you owe some tax, you don't know how much it is or how to pay it, and you wind up on April 10th of this year, say, I owe $3,000. And in addition, you also owe the next installment of the next year's taxes. So you can get behind it.
Thank you very much for watching. If you would like to see more videos by California Lawyers for the Arts, please like and subscribe to CLA's YouTube channel so we can provide full-service live streaming programs soon. Our channel will be producing videos that cover all kinds of artistic, entertainment, and intellectual property legal issues. You can also find our videos on Facebook and livestream.com.